Good day and good morning, everybody. Trevor Hall here, Mining Stock Daily, and this is your long-form episode to get you through what's going to be a long weekend, as we will be away Monday for the President's Day holiday, back Tuesday morning. Thank you so much for tuning in. We had a lot of corporate updates in throughout this week. If you missed any of them, please go back and you can go check them out at clearcommodity.net or miningstockdaily.com for a full rundown of this week's episodes. And it was a volatile week, unfortunately, with the CPI inflation report coming in a little bit hotter than expected. And that had ramifications through the metals sector, obviously, as interest rates were on the rise. We're going to talk about this with our friend Ronnie Stoeferle from the In Gold We Trust report. Good conversation with Ronnie, talking all things precious metals, gold. It's what's happening with the interest rates and the price of gold as it hovers above that $2,000 mark for now. We'll see what happens the next $100, $150. So good conversation with Ronnie. In the second segment, we're actually going to pull an excerpt out from an interview from Clear Commodity Network's a Power Current podcast with Chris Berry. Our friend Chris did an interview with Reuters journalist Ernest Scheyder regarding a book he has published recently called The War Below, talking about the metals and mining sector for battery metals, including copper, lithium, cobalt, and the like. It's going to be an excerpt, and we'll put a link into the full episode of Chris Berry's Power Current so you can listen in to that entire episode on your own due time. So 2 segments here, one with Ronnie, one with Chris Berry and Ernest. So everybody, thanks so much for tuning in. We'll be back Tuesday morning after a holiday break here in President's Day weekend. Have a wonderful weekend. Be well. All right, we're in here on the MSD long form episode, the first segment with a good friend of ours. He is a fund manager over at Incrementum. He's also the author of the In Gold We Trust report. Showdown is the latest publication from later last year. Happy to welcome in my friend Ronnie Stoeferle. Ronnie, good morning or good afternoon.
Hi, Trevor.
It's good
Thanks
to see
for having
you.
me. Good to see you.
Yeah, it's good to see you too. It's funny because I remember, we had a great dinner back at the Beaver Creek Precious Metals Summit. If you, me, Tony Greer, and
Brent Johnson.
And Brent Johnson, it was just one of the highlights of that event, actually.
We talked about our favorite conspiracy theories, right?
Yes, we did, yes. Amongst other things as well. But one of the stories I don't think I told you that night was like Tony Greer and I sat in on your presentation at that event, and I handed him this In Gold We Trust report, the big one, the non-redacted ones, and he's like, "Wait, that guy wrote all this, put all this together?" I was like, "Yeah, man." He's like, "Oh my God, how long did it take him? Like 5 years?" Like, "No, he does it every year." Yeah. And he was just blown away. So first of all, I guess, congratulations. I'm sure people have really been picking this up and maybe referring back to it the last couple months, because if you're a gold investor, your head's got to be on a swivel here the last couple months, specifically the last couple weeks. So maybe just a general question for you, Ronnie. Like, how are you kind of observing the gold trade here in the first part of 2024? What's maybe caught your attention and maybe caught you by surprise?
Well, first, Trevor, I have to say it's not just me writing the report. It's a team. There's like 20 people working on this report, and the next one will be published on May 17th. So we're already in the research and writing and numbers crunching mode, and that's why I'm trying to grow a beard, which looks ridiculous, as my wife keeps telling me. So what's going on in the gold world? I think it's just one big trade at the moment. We've seen last year in October, on a scale from, let's say, -10 to +10, the sentiment was like -8. And then everybody got kind of excited, and then we had Jay Powell in December, basically communicating the big pivot, and then the market basically went crazy and discounted up to 7 rate cuts in 2024. So we went from -8 to +8 in terms of positioning and sentiment. And with the start of the year, I think everything started to cool down. Everything but those Mag 7 stocks, but now I think it's only 3 or 4 left anymore. So the market is getting more narrow and narrow. And I would say in the gold camp, I'm pretty relaxed. Gold is down 3% in US dollar terms this year. It's up in most other currencies. Gold was up 13% last year in dollar terms. So we're still hovering around the 2000 very, very important psychological level, obviously. And people are still complaining and are pretty negative. And I think that's a pretty good sign. And it's telling me that we're far away from euphoria. And let's face it, the fact that at the beginning, or let's say like 3 weeks ago, the consensus was still 7 to 8 rate cuts starting in March, and now it has moved to June. We're now seeing what is discounted, and this can change obviously pretty quickly. Now we are seeing 90 basis cuts. 90 basis points of rate cuts this year, and it used to be 175 basis point cuts. So that was a pretty significant move, and I think that gold held up quite well in this environment. What didn't hold up so well was obviously the mining space.
Yeah, we'll obviously talk about that a little bit later in the conversation. Once we get to, at least we'll try to get some silver lining in there before we get to the not so great news. Ronnie, we interviewed Peter Grosskopf a couple weeks ago in Vancouver, and he had a great kind of, I guess, a line, for better words, and one of the answers he gave to us. But he said the next $100, $150 in gold is going to be the most important, whether that's up or down. And so I want to kind of take that idea and push that on you. Do you feel like the next $100, $150 in gold is either going to be that make it or break it in the short to mid term here for the gold price and gold investors?
I wouldn't see it as that dramatic, to be honest. I can clearly see gold going down to 1900 or 1850, and it wouldn't worry me at all. I think the long-term trend is still crystal clear, and as I've said, at this point in time, I think what's really important, and I showed quite a lot of charts in my recent presentations. The best is yet to come, because gold has been holding up so well against a significant move in real interest rates. It held up so well against interest rates going from 0 up to above 5%. Who would have expected that gold would be trading? If you would have told me like 2 years ago, interest rates are above 5%, inflation numbers are coming down significantly, everybody is talking about the soft landing or no landing, or now the new term is no session. So that's the new wording. I would have told you that gold is probably going to be trading around 1,500, but not at $2,000. So I think once we see that the Fed really starts cutting, once we see that, and this can happen pretty quickly. We just need one really bad jobs report, and I think this move that we've seen this week in inflation numbers and also in the supercore and sticky inflation numbers. So I don't think that inflation over the next couple of months will rise up again. I think we're clearly in a downtrend because of actually, and that's the fascinating thing that we're seeing. We're seeing an enormous amount of deflationary pressure. So money is becoming really scarce. We can see that in the mining space, obviously. So I would say, and that's one of my key takeaways from my recent presentations, the great moderation is over. We should expect more inflation volatility, but for the time being, I think disinflation is the name of the game, and therefore, I think the pivot is already being prepared, and if they start cutting rates in March, in May, or in June, it doesn't really matter. What really matters for gold is, I think, this strength that we're seeing, despite the fact that investors are selling. Last year we've seen 244 tons of outflows from the ETFs. And what's the reason for this development that gold is holding up so well? It's actually central banks, yeah, and it's Eastern central banks, and that's one of our core topics for the last couple of years. We've been saying that the center of the gold world is moving to the east, and the price of gold is less and less being made in New York, in London, and in Zurich, and more in Dubai, and in Shanghai, and in Mumbai. And I think that many people in our industry completely underestimate that. Just go to Shanghai, go to India, go to Dubai. I was there at a conference last year. It's really staggering what's going on in terms of gold over there. And they couldn't care less about the daily price fluctuations. They're in for the long game. So long winded answer to your question. I don't think that the next 100 or 150 bucks are really decisive.
Okay. Well, maybe I do want to ask you about price of gold in foreign currencies, not just the U.S. dollar, because obviously we spend a lot of time talking about U.S. dollars and gold, or gold and U.S. dollars. But what are you seeing in the foreign currencies? We've seen relatively all-time highs in a lot of currencies. Has that been kind of subdued at all lately? And any currency that really stands out?
It's obviously the Japanese yen. I mean, last year gold in Japanese yen terms was up 22%.
Wow.
So if you have a look at a gold in Japanese yen terms, it's really from the left bottom up to the right top. It's a perfect uptrend. And I mean, let's face it, the Japanese yen is not an unimportant currency. Yeah, it's still the third biggest currency out there. So we're seeing it in Japan, but we are also seeing it in Euro terms. For example, gold is up, I think, 9 out of 10 times in the last 10 years. We're seeing, obviously, also in Canadian dollar terms, we're seeing in Aussie dollar terms. I think that this fact that gold is really in an uptrend in basically every currency, and that it has made new all-time highs now in US dollar terms, finally, last year, I think this is a clear sign that clear sign of the strength of this bull market. So therefore, if you have a look at, we will have a chapter in this year's report about gold in Japan, and it's crystal clear that the weaker the currency is, the higher the demand for gold as a means of protecting your purchasing power. And you don't have to travel to Venezuela, to Argentina, and Zimbabwe to see those developments. We're also seeing it in the industrialized nations nowadays.
Yeah. Recessions are typically deflationary in nature, right? And so let's talk about, we're starting to see recessions pop up. Obviously, Germany has been going through a recession here for a number of months. I'm not quite sure where they're at. I haven't received an update on if they've gotten through this or not, if they're kind of slowly climbing their way out. They're obviously China, although they perhaps will not admit it, but that seems very recessionary right now, given where their markets are and their issues with real estate and development there. I also saw news Japan has hit recessionary factors here in the last 24 or 48 hours as well. And so we're starting to see these recessionary, deflationary news items kind of pop up slowly and kind of mercurely in many ways. It's not yet hit the United States, although there's been speculations for the last 2 years that it's inevitable as we have an inverted yield curve, which is still inverted, yet somewhat of an incredible mess throughout the curve. But it does appear like it's slowly creeping into the United States. And this will have ramifications on what the Federal Reserve does decide to do with interest rates. And we can kind of go back with the market expectations versus the Federal Reserve dot plot. And and I've said since the beginning of the year that it seems like the markets were well over their skis with that rate cut expectations following the December news. That's obviously pulled back here a little bit with the latest CPI data this week, came in hotter than normal. My thought is that I do think the United States Federal Reserve will cut rates at some point this year. My expectations, however, are that will actually happen later in the year, closer to the election. Or if it comes early in the year, it's going to be because they have to. Something happens, and it will not just be, a quarter or a half a point rate cut. It will be something much larger because something could happen to the system has bigger cracks. And so I guess, kind of looking forward in how these rate cut expectations are kind of frothing up from market expectations to central bank expectations. How are you kind of keeping this level? What would you kind of expect to see? Am I kind of on course here with a similar fashion what you're thinking, or do you completely disagree, I guess?
No, I mean, I have to admit, Trevor, we were in the recession camp last year, and we've been we've been wrong. I think we completely underestimated the enormous amount of fiscal stimulus, especially in the United States. So I think the U.S. is running a pretty tight monetary policy and a very loose fiscal policy, while Europe is running a tight monetary policy and a tight fiscal policy. And in China, it's the other way around, actually. They're running a relatively tight fiscal policy and the loose central bank policy. So I think that's pretty interesting to observe. And for the United States, I mean, if you're running an 8% government budget deficit in a year with full employment, obviously that has consequences. So I think we underestimated this fiscal dominance. I tweeted out a paper today that came out by I think the Federal Reserve St. Louis, which was pretty actually it was pretty clear that they were calling out the inflation tax, and I think I summarized the highlights of that. I thought it was pretty eye-opening that they're really that blunt about it. So it is really something that we called the monetary climate change that gave us quite a lot of criticism from the Greens over here, where we said, well, actually, fiscal policy is becoming much more important than monetary policy, and the change clearly was in the year 2020, when all those things, kind of helicopter type of money, very direct fiscal stimulus, basically became mainstream. And I think that politicians, their first ambition is to be reelected, and I think they kind of liked it, to see, if we're handing out checks and stimulus, it works pretty well. So I think that the U.S. has been even more aggressive when it comes to that fiscal dominance than the Eurozone. And I can tell you, over here, we attended a big fund conference end of January for 2 days in Germany, and the situation is really, it's quite, let's say, pessimistic, negative. It felt really depressing, actually, that there's everybody is kind of writing off Germany, it seems, and it's not only Germany. I mean, so many countries are dependent on the German industry. in Europe. France is not doing very well. So actually, with Europe and China not doing particularly well, with a couple of wars going on, it's really fascinating that the U.S. really stands out. But I think it's as I've said, mainly due to this enormous amount of fiscal stimulus. You mentioned the yield curve. It is kind of steepening now. So we've seen the lows for most curves in summer last year. We're seeing the leading economic indicator, which is, from my point of view, still one of the most reliable indicators. It's down 20 month in a row. And we're seeing also for many indicators that I'm following a little bit below the surface that the numbers are weakening. So I still think that the US will hit a recession sooner or later. We've got an election year, obviously. Usually the Federal Reserve tends to be more on the dovish side in election years. I don't think that Jay Powell, what did Trump say about Powell? He's like a golfer who cannot put or something like that, and he said it was his worst decision that he made. So I don't know. I don't think that Powell really wants to support the case for Donald Trump going forward. So I think that therefore the Federal Reserve will rather be on the dovish side, but they need an excuse, and they will try to find an excuse. And we're seeing lots of things happening in the commercial real estate space. From what I hear in private equity, there's quite a lot of stuff going on. So I think it's an accident waiting to happen. But it's really, for me, it's really staggering that it's taking so long.
Yeah. This morning, Jared Dillian sent out his morning Daily Dirt Nap note, and he was actually talking about the election this morning coming up here in November. And I have kind of had the argument that it doesn't matter who the president is, whether if we have a Biden-Trump election, whoever wins, they will continue to push for lower interest rates, either heading into the election via Biden or after the election if Trump were to win. But Jared reminded his readers, and specifically me, that he said, I've never heard Trump talk about deficit reduction. Not even once. Which completely goes against a lot of his base who really care about deficit reduction. But as we know, if you look back at the first Trump presidency, nothing of the sorts even happened. There was deficits went up and continued to do under every president here. I guess kind of watching this, and lucky for you, you don't have to live in the United States during this time. But watching this, I mean, I just do not see a case where interest rates stay this elevated. If they can afford to, if they can afford to cut at some point under whatever presidency.
There's I don't know. You probably mostly follow American football, but not what we call football, so soccer.
I do.
You do. So Manchester United, right?
Yes, I'm a Chelsea boy myself, but yes.
Okay. So there's a former manager of Manchester United, Sir Alex Ferguson. He said, and it was kind of a famous 3-word. He said, "Lads, it's Tottenham." So that was his pre-match talk, and he was reflecting to this widespread belief that the Tottenham, the Spurs, that they always crumble under first signs of pressure. And I don't know who it was, but somebody said, "Lads, it's the Fed." So there's no doubt from my point of view that they will crumble if there's some pressure. And the pressure is probably going to be, economic numbers coming in weaker than expected. And we've already seen it with the, with the banking crisis last spring. They were pretty quick to inject 400 billion into the system. So from my point of view, there's really no doubt, but we have to give credit to Jay Powell. with his narrative that he's like the Paul Volcker 2.0, and always referring to Paul Volcker. I think he kind of regained lots of credibility for the Federal Reserve, but that doesn't mean that they will lose it at some point again.
Yeah, I agree with you. It may not be a popular thing to say, but coming off of that inflation is transitory baloney at the time, he definitely he pivoted then, raised interest rates, had that incredible things are going to be tough from the Jackson Hole economic symposium. People kind of understood that he's putting his foot down here, but we'll see what happens from here on out. And I had this kind of question, given where we're at with 5.25 interest rates and markets still pushing up close to all, making new all-time highs, no recession inevitable. We are seeing cracks in the system with corporate real estates and regional banks, obviously, but you kind of wonder if they fold, if it's going to take some sort of regional banking contagion, more corporate real estate foreclosures. What will be that limit where they say, okay, enough is enough, we'll cut 0.5 point, and even if that's going to be enough. But given where we're at, like I'm pretty surprised at 5.25 we've been able to chug along as well as we have here in the United States. And I also, on the back of that, think it's like, well, then why the hell were we doing ZERP for so long when obviously we were fine at 5.25?
I think that, yeah, I agree, but I think what I'm increasingly seeing is those those bond vigilantes riding again. So really the credibility of the United States as a lender is becoming questioned. So as I've said, we've had 9% or 8 or 9% budget deficit last year. So that's the biggest in 100 years outside of any war or recession. The federal debt is up 10 trillion since 2019, and just one more number. I think before COVID, interest payments on that were roughly 1 billion per day. Now it's 2 billion, and it's rising basically exponentially. So that's really becoming a concern. On the other hand, as our friend Brent Johnson always says, it's a relative game, yeah, and right. Perhaps the US is still the least dirty shirt, and just one. It might be anecdotal evidence, but when I went from Denver up to Beaver Creek to the conference, I talked to the driver and said, just want to have like small talk, and said, how's the economy? And he said, which economy? My economy is good because I'm working hard. I'm starting a new business now. And if my economy is not doing so well, I'll just move somewhere else. Yeah, I'll start a new business. I'll work even harder. And actually, this is really a big difference between the United States and Europe. Here, everybody is just complaining that the government doesn't create enough jobs, and that the market is so bad, and there's so much competition. So this is really a significant advantage, this flexibility that the US market has. So still, if you ask me, which currency do you want to hold for the long term from all fiat currencies? Is it going to be the euro, the Japanese yen, or the dollar? Obviously, it's going to be the dollar.
Yeah. I know we only have a couple minutes here left, Ronnie, but I do want to ask you about the gold equities. Some interesting news in the last 24 hours. Stan Druckenmiller, one of the greatest investors, traders of our generation right now, is dropping some tech stocks and actually moving in, positioning himself into Newmont and Barrick. I guess he is a contrarian, because look at those. If you look at the charts of both Newmont and Barrick, especially this week, it is ugly. But here we are. We got a big name investor moving into the major miners. Obviously, I would doubt Stan Druckenmiller would move into the mid tiers because he's looking for liquidity always. But that's a pretty good sign. I mean, maybe it's a little too early to pat each other on the back because we've suffered for so long, but this is a good sign.
Yeah, I mean, I have to tell you, my day started Yeah, let's put it that way. We've been working on our new fund for ages, and then we said, okay, it's gonna be the 15th of February when we launched the fund. We didn't see inflation numbers coming in much hotter than expected. We didn't see that further turmoil in mining stocks. But then we said, hey, I mean, actually, from a risk reward perspective, it's the best time to set up a new fund in the mining space. Yeah, and all great investments begin with discomfort. So I was reminded to a story when John Hathaway back then when he was still with Tocqueville, I asked him, so John, why did you set up a gold mining fund at the end of the 1990s? And he said, well, the story is we had a strategic meeting at Tocqueville, and we thought about new funds. And then I said, let's do a gold mining fund. And everybody started laughing. And he said, okay, this reaction was exactly the reaction that you want to see, because it was he knew that it was super contrarian. So John emailed me this morning, and he wrote, I'm wishing you the best of luck with your new fund. I hope your timing turns out to be as good as ours 25 years ago. The idea as a contrarian today, as it was then. We started with 10 million and grew that to over 3 billion at the peak. Probably a month or two before the turning point, but that is the time to start. So yeah, I mean, this plus Dan Druckenmiller coming out, and I love Druckenmiller. I mean, he said it takes courage to be a pig, and there's just so many great quotes from Druckenmiller. So I think it's tough out there. We both know the industry very well, and there's really real suffering in the industry, and I'm seeing financings at ridiculous levels with terms that you as a buyer you feel very happy. On the other hand, I think we're clearly seeing this deflationary move, and my theory is kind of that the mining space, and especially the junior mining space, really suffers first from these moves when we're really lacking liquidity, and then it's profiting only later on. So I think, even though people, I think, would hope that with the pivot and rate cuts, everything's gonna be fine for the junior mining space. I don't think so, unless Fed will not go to zero right away.
No.
And even if they would, there is still significant time lags involved. So I think it's gonna continue to be tough in the small cap space. I would say for the large caps, they're producing decent amounts of free cash flow. I think that the cost inflation will be somewhat under control this year. We saw it already last year. I think that people tend to forget that dealing with inflation and new situations, that's a job of business owners and
Right.
management. So everybody was, of course, working on how can we deal with inflation, how can we reduce costs. So I think quite a lot of positive things happened in that space. And I think when it comes to valuations, I mean, we're seeing the lowest valuations in 25 or even 30 years. So if you have a look at the spread between the gold price and the discounted implied to spot based on the market price of equities, it's a massive $200 per ounce at the moment. So do I feel comfortable with setting up or launching a new fund in this environment? For the short term, it's tough. But as I've said, I think it's just to say one word. I don't want to advertise it here in our conversation, but I just learned throughout my years in this industry that offense wins games, but defense wins championships. So the mining space is not a long only space. So what we do in this fund is we're not long only mining stocks. We're really active, so we can get 100% out of the mining space if our signals are telling us. And I think that's the right approach. But now, it's probably be the time to really do your homework, pick up good quality names, and just be patient.
Yeah. But you feel there's a little bit more suffering in the junior equities to come. What's it going to take to start lifting these things up? I mean, increase the volume on the venture exchange. That's all in general. I mean, anything.
Well, it's going to take time, and as I've said, it would be naive to think that the rate cuts are coming and everything's going to be fine again. I think that the sector has some sort of a marketing issue. Um, I think that I said that in a couple of interviews recently. When it comes to gold, but when it comes to mining in general, we're here in our little bubble. But outside of our little bubble, actually, people couldn't care less about gold. They couldn't care less about mining. They think that gold is completely useless, while obviously lithium, cobalt, and those other green and strategic metals, that's just that's marketing wording. They're good ones. They're positive ones, while gold is a bad one. And then of course the lack of performance and poor delivery, poor management, poor not any leverage on the price of gold itself. So I think the industry really has to make up quite a lot of things, and I know brilliant management teams where I'm super confident that they are in the position. But I think there's still lots of rubbish companies that are now being renamed or are merged, and I think they should go down like in every normal cycle. And I hope that all this kind of shady promotion of junior mining stocks will at some point also come to an end. I think there's and it really bugs me because there's so many great people in this industry. But I think at the moment our industry has a really poor reputation, and it will take time to repair that.
Yeah. Ronnie, thanks so much for your time. It's good to connect with you. And I look forward to that next meal I get to share with you. And maybe we'll get a few others to talk about more conspiracy
Absolutely.
theories or whatever.
Thank you very much, Trevor.
I saw some pictures. How's the skiing over there? Is you starting to get some more snow?
It's okay. It's okay. Yeah. I mean, it's the best family sport. So we always enjoy hitting the mountains with the kids, and yeah, it's decent snow, but it's not outstanding. But
yeah.
doing
I
our best.
I saw a stat the other day that said like from birth to age 18, it costs an average of like $237,000 to like raise the children, and I was like, yeah, you should triple that if you take your kids skiing.
But Trevor, our gold beer ratio, and we also have the gold iPhone ratio. We did the same with ski tickets.
Oh yeah.
Yes, and actually, and that's not for the US ski resorts like Vail or other resorts, but that's for the big Austrian ski resorts. And actually measured in gold since the year 1990, you're having a higher purchasing power. So the prices of lift tickets, of ski tickets, go down measured in gold. So it's primarily the lack of purchasing power, the falling purchasing power of the euro. So
I'll pull that out for my wife here when she asks me why I'm going on my third ski trip. Okay, Ronnie.
All right,
Ronnie
Trevor.
Stoeferle,
thank you very much.
Thank you so much. All right.
Take care. Thank you. Pleasure. Bye-bye.
Mr. Ernest Scheyder, welcome.
Hey, it's great to be with you, Chris.
Absolutely. It's great to get to talk to you about what is a terrific book that you have written.
Thanks to be with you. Really excited to talk about The War Below with you and the power current.
Yeah, absolutely. I think, look, maybe to start, I think, there's always a format for these podcasts, right? And many people listening to this, I think, first of all, if you haven't gone out and purchased this book and read it, you should. But for those of you, some people will be familiar with you, some people may not. Just give us a little bit about your background and how you got to where we are today.
Sure. So, my day job is at Reuters, where I write about the critical minerals and mining industries. And I've been writing about this space for about 5 or 6 years. And the book really is an outgrowth of the reporting that I've been doing at Reuters in that time frame. And it builds off of my entire career. Before I wrote about critical minerals, I spent about 4 or 5 years writing about the oil and gas industry. And Reuters actually sent me to live in North Dakota. I was living there for about 2 years in Williston in the western part of North Dakota. So living the fracking boom and bust from a unique perspective. And so the book really builds on all of that reporting and is a ostensibly book about energy, but really it's a book about people. It's a book about the choices that we need to make if we want an energy transition and if we think climate change is serious, which I think most people would agree that it is. What are the decisions that we're going to make in order to get the building blocks for solar panels and wind turbines and electric vehicles? And on an even more practical level, there's a whole host of electronics nowadays that are increasingly powered by lithium ion batteries. And those might not have anything to do with the energy transition, but still underpin our everyday lives. Things like cell phones, laptops, et cetera, et cetera. And all of these are built with critical minerals. So, what I wanted to bring to the audience here is this idea of choice. What are the choices we're willing to make if we want these products that really underpin our everyday lives?
So when I, read through the book, I came away with a sense of a very divided, contentious debate that doesn't have any easy answers. I feel like if there were easy answers, we would have found them at this point in time. I mean, what do you think some of the, and you speak with all sorts of people. You speak with miners, you speak with environmentalists, you speak with government officials very clearly. What do you think some of the main takeaways are from this book? In other words, how do we get to the other side with respect to finding pragmatic solutions?
Sure. I would say the number one takeaway that I did find that maybe contrasts with my time covering oil and gas is that most of the people I talked to for the book, and indeed in my day job at Reuters, acknowledge that we need critical minerals. There's sort of a broad understanding that lithium and copper and cobalt and nickel and rare earths are going to be needed in increasing quantities. The tension that I really explore in the book is a lot of folks saying, no, just not next to me or not in my backyard, is the
NIMBY.
stereotypical euphemism. NIMBY, yes. And when you sort of add each of those instances up, you get to paralysis in terms of production. And I'm at pains in the book not to really inject my opinion into whether some of these projects are right or wrong, or whether the opposition is good or bad, or whether the supporters are fully altruistic or coming at it from other perspectives. I think it's for the reader to determine for her or himself what they think of it, because some of the oppositions to these projects are just really complex areas. I chronicle the journey of the Resolution Copper Project in Arizona, about an hour east of Phoenix, that is strongly opposed by Native American groups, especially the San Carlos Apache people, for religious and historical reasons. And I don't think it's my job as the author here to make a value judgment as to whether or not those opposition points are valid or not. But
Hmm.
they exist and they are here, and they form a strong opposition to this key source, what could be a key source of copper. And copper anchors, really, I argue in the book, the energy transition. And so had the honor to talk with the San Carlos Apache, with the indigenous groups opposing this mine, as well as the honor to talk with the company that wants to mine this copper, and many other groups that are, I would say, sharing different perspectives. So another thing I bring to the reader here is it's not always one side versus the other. There's multifaceted angles here. And you've got in this resolution saga a town, Superior, Arizona, that strongly wants the mine, but is very focused on doing what's best for its people and insisting that the mining company um, basically give more to the community. And so you see in the narrative here how there's not this complete acquiescence to whatever the mining industry wants. So it shows the reader the multifaceted nature here of many of these complex issues, and brings this idea again of choice, what we need to be thinking through if we want this transition.
Glad you brought that up because I wanted to actually read just sort of a half a paragraph here from the book, and it's from the chapter entitled Sacred Space, which of
Mm.
course focuses on everything you're talking about. And so just towards the end, you write, the appeals court in June 2022 ruled for Rio and the U.S. government. Apache Stronghold had lost the battle, but vowed to appeal all the way to the U.S. Supreme Court if necessary. The saga exposed complex, deep-seated issues that needed to be addressed if the world hoped to go green. And central to all of those issues was one simple question. What exactly is good mining? And you have the word good in quotation marks. So you talked about that a little bit previously, but who ultimately decides what good mining is? I mean, is this something where I think the courts are going to figure this out for us here in North America, or does it take a whole new approach? What do you think good mining is, and who ultimately is going to determine this?
I think there is certainly going to be a judicial and a legislative partial answer to this question. And as you mentioned in that paragraph, we talk about sort of appeals courts. There's also a legislative approach that could get steam in the U.S. Congress, because there's the law that's overseen mining in the United States has been around since 1872, which is, a very long time ago, and has not obviously been updated in any sort of major way in recent years. So there could be, I would say, two buckets right there. What I would hope, though, and I bring to the reader here in the book, is the idea of good mining is ultimately going to be up to us, like what we as consumers want. A great parallel I would see would be the apparel industry. When people discovered that many of the clothes they buy from the brands that they love were using sweatshops in parts of Asia, that became anathema to many consumers, and still is. And so you're starting to see increasingly that some consumers are willing to pay more if they know definitively that the clothing that they buy is ethically sourced and ethically produced. And I would say, and I do argue in the book, that consumers are going to increasingly want to know that the electronics that they buy, the electric vehicles that they might buy, are not built with metals where children are part of the supply chain. Sometimes kids as young as 6 or 7 in the Democratic Republic of the Congo can be part of the cobalt supply chain. Cobalt, a key battery metal. They also want to know that, for instance, was there lithium in that battery produced ethically when did that respect water rights? For instance, northern Chile and the Atacama, huge desert. So you can imagine mining uses a lot of water. Is the lithium production there respectful of the water rights? Those are just sort of two examples, but it's going to increasingly require consumers to push for these metrics from the manufacturing industry. And the chapter right after this paragraph that you just read, Chris, looks at how Tiffany and Company, the jeweler, this iconic jeweler with this, the light blue box. Everybody knows the light blue box. It about 15, 20 years ago helped push forward this idea of what is good mining, because Tiffany, it buys a lot of metals, all right? You can't have an engagement ring without platinum or gold or silver, etc. And so for Tiffany, it was an existential question, right? They didn't want to support bad mining practices, but they're not a mining company. And so that chapter in The War Below dives into what steps Tiffany took, along with several other NGOs, to form what's known as IRMA, or the Initiative for Responsible Mining Assurance. And that was their way to help put their stamp from what their perspectives were on what is good mining. And IRMA was fascinating for me to explore, because it actually doesn't sound like it would ever work. You have mining companies working with labor unions, working with environmental groups, working with investors, working with indigenous organizations, working with mining customers, and you put them all in the same room and you lock the door, and it sounds like they'd all be at each other's throats. But what they did do over the course of about 10 years is extremely slowly get standards together for a mine. Sort of what are the best practices for water usage, for making sure your neighbors know that if there's an accident at the mine, they're alerted promptly and safely, that the workers are paid a living wage, that waste is taken care of and stored in a safe manner, and many other factors. And then the results of sort of this test are publicly displayed so that everybody in the world, including mining customers, and yes, me and you and everyone else on the street, Chris, knows exactly how a mine stacks up. And that is going to increasingly be required, I argue in the book, by a lot of not only consumers, but manufacturers. Already we've seen Ford, BMW, Microsoft, and others get behind IRMA and say that this is the schema that describes for them what is good mining and what they're going to want from the mining industry.
I'm glad you brought that up. It's a great segue. The title is, of course, The War Below: Lithium, Copper, and the Global Battle to Power Our Lives. But you go way beyond lithium and copper. To your point, you talk about diamonds. There's a chapter in here on rare earth elements. There's a lot of ground you cover. I'm just curious, how did you figure out what to cover in the book?
Well, it was important for me to look at sort of the broad, call it five here: lithium, copper, cobalt, nickel, and rare earths. The subtitle of the book, it doesn't necessarily flow when you have all five in a subtitle. Lithium and
Yeah.
copper also, of course, are I would say the workhorses
Hmm.
for many of these electronic gadgets and gizmos that are out there. And many of the battles do center on lithium and copper, and not to reduce the import of rare earths or others. But it was important for me to also explore those in the book and the narrative as well. Take rare earths, for instance. We look at the history of the Mountain Pass mine in California,
Hmm.
which has had sort of a very up and down um, saga over the
History.
course of
Yeah,
its
for sure.
history, related to ESG issues, to ownership, to bankruptcy, to its current owner, which was helped by a Chinese partner to resuscitate the site. And you can't have an electric vehicle without rare earths. Rare earths are used to make magnets that turn power into motion. So, given their import there, it was important for me to explore that. Also, the geopolitics of these critical minerals, I find, interacts directly and especially with the rare earth saga, given that China has all but cornered the entire rare earth industry. And I argue in the book that part of the reason China's economy is the second largest in the world is because of its huge focus on this area. So it does also attempt to weave a lot of these together as a core part of the narrative. And the tension in each chapter, I think, comes through and reflects back to this idea of choice. And it was important for me to not just have a geology textbook or a book for Wall Street investors, but to really show the people on all sides of this issue. Because at the end of the day, this is a story about people, because this is an issue that affects all of us.
Yeah, I think you sort of hit the nail on the head there. Every group has their own motivation for wanting to be involved in the supply chain, right? I
Yep.
mean, MP, or Mountain Pass, which became, MP Materials through the SPAC, was motivated from, a private equity sort of perspective. And then, of
Sure.
course, you've got the Chinese perspective. And speaking of China, how did you, in the research for this book, did you visit China? Did you speak with Chinese miners? Did you speak with supply chain participants? I'm just curious, if you got any sort of a, let's say, Asia focused perspective or background for some of what you wrote in the book.
So the book was written primarily during the pandemic, so
Mm.
was not going to get into mainland China for obvious reasons.
You might
But
get
it
in,
was
but you won't get out, right?
Well, there's that. Yes. But China here is a huge part of the narrative, given its investments not only in MP and Mountain Pass, as you mentioned, but also its expansions into China. There's a chapter that looks at the cobalt mines in the Democratic Republic of the Congo, the copper and cobalt mines that used to be controlled by Freeport-McMoRan,
Hmm.
but due to the company's debt load, partially linked to its ill-fated and ill-timed investments in oil and gas, required it to sell this. And so China swooped in, CMOC, and invested in those assets, and today is one of the major producers there. And China's investments in the magnet space, in the nickel space, and the cobalt space also form part of the narrative. So for me, it was important, certainly, to include it in the narrative, but I focused essentially on and broadly on projects mostly in the United States on purpose, because I really wanted US consumers to think through this idea of where are we willing to accept mines, and are there some places that are too special to mine, or if we don't like the idea of having a 7-year-old in the Congo, which is the starkest example, mining cobalt, well, are we willing to allow it here in the United States? And if so, where would those places be? Because I do believe strongly that the time of the average consumer just putting his or her head in the sand and expecting to show up to a store and have a product on the shelf is over. Think about it. It was about 4 years ago this month, Chris, that the pandemic really started to grow full bore, and we discovered that the United States doesn't produce any masks. That was, the most basic medical piece of equipment that we see as crucial in order to preventing the spread of the pandemic, and yet we didn't make any in the United States. I think that really crystallized for the average everyday consumer how important supply chains are. Supply chain used to be sort of a boring, sleepy topic, but if the pandemic taught us anything, it's like the supply chains matter.
Right.
And so these are the big things here.
Yep. Sorry, didn't mean to cut you off there,
No,
but
that's, yeah.
you're sort of leading me down the right path. Every sort of question I was thinking about, you're going there. And the next question really revolves around, you talked about the Chinese sort of dominance along different pieces of the supply chain, whether or not it's with copper or rare earths or what have you. And much of that investment is through state-owned enterprises, right? In
Yes.
general. And so, as we in the West try to compete with that model, to the extent that we can, just curious, what is the proper role of government in this transition? I know that's kind of a large question, and I'm not really trying to box you in here, but given that, you could, I think it's fair to say that, hey, we're here in the West and we believe in free market economics and the Adam Smith invisible hand and, et cetera, et cetera. And, in China, I think in general, it is a somewhat different story. It's very top down and state directed, and sort of, let's think about where we want to be in 15 or 20 or 30 years, right? And so that's how that has been the Chinese industrial policy. At least that's my sort of perspective, right? So what do you think? I guess this is sort of a two-part question. How do we in the West compete with that? And given to your point, the need to push forward with this energy transition, whether or not it's economic competitiveness or climate change or what have you, how do we do it? What's the proper role? Is the IRA enough?
Well, one of the things that I point out many examples in the book of instances where one arm in Washington does not seem to know what another arm in Washington is doing, and so the short of making policy recommendations, I would say that Washington is not speaking with one voice, and should and can help the critical minerals sector here in the United States by speaking more clearly. I mean, a great example is the Resolution Copper Project, which we were discussing earlier. The Biden administration unapproved it after the Trump administration approved it right before leaving office. And meanwhile, there was a related court case where the San Carlos Apache and their allies were fighting this mine in court. But meanwhile, in that court case, President Biden's Department of Justice attorneys were defending their right to give away the land to whoever they wanted. So it seemed to be speaking with sort of two different approaches there. Another example is in northern Minnesota, where there's the Twin Metals Copper and Cobalt and Nickel project. And this would be a massive producer of those metals for the U.S. economy. But their concern right there is that the type of rock that contains those metals could, if exposed to water, form acid. And that, what's in northern Minnesota? The Great Lakes. And if you put acid into the Great Lakes, that's not a good thing for obvious reasons. But the the Biden administration, has basically put that whole project on ice. And the company that wants to develop it, Twin Metals, has been very strongly saying it feels it can produce these metals safely. But the tension point there gets further exasperated by the fact that President Biden invoked the Defense Production Act to boost U.S. production of critical minerals, which just caused a lot of people to scratch their heads. And in fact, the very same day that Biden invoked the DPA, an executive from this company testified before the U.S. Senate and basically said that the company does not feel the United States is a stable regulatory jurisdiction anymore, which is very, very pointed words, So you've got President Biden invoking the Defense Production Act. At the same time, he's putting on ice this major potential source of these critical minerals. And so this gets back to this idea of choice, which for me, it just formed the core of the book. If I've learned one thing from writing this book, it's you get to ask one question of your audience. And this is the question I'm asking is, what are the choices we're willing to make? And we're not speaking with one voice on this issue. And so if we're not going to produce more of these metals here domestically or at ally countries, then we have to accept the fact that some countries are willing to use them as economic weapons and use that control to really shape the global economy in their image. And I chronicle in the book as well some efforts, especially around rare earths and other critical minerals, the attempts by China and others to do just that.